morning, everybody. Thank you guys for joining. I am Noah Rosenblatt. That is John Walkup. We are both with UrbanDigs, and it is Monday, so you're going to get a little macro Monday coming right at you. For those of you that are new to the show, we're going to start out with Manhattan real estate. We're going to hit you up with a couple of macro topics that we think are critical talking points that you need to know, and then we're going to circle back, and we're going to end with Manhattan real estate. We're going to try to do this in the next 30 minutes. Johnny, we are live on YouTube.
Live on YouTube. So thank you, everybody, for following us over here. At least I hope you followed us over here. In the meantime, I just want to say that this is now hopefully available for everybody. So feel free to pass on the link and have people join us because it's going to be a lot of fun. It's
new, guys. There should be a comment stream right over there that you guys could talk to each other over there. I think there is a delay. 20-second, 25-second delay. So if you guys have comments to put up there, we'll try to match it up with whatever we're showing over here. I hope you guys will like us. I hope you guys will subscribe to us and help us spread the word about this show because it's good stuff and it's changing macro environment. Very, very important topics. And Johnny, let's get right to it. You ready?
Yeah. Okay. Why not?
All right. I want to start out with my ticker right over here. I'm on the market snapshot. I'm on the market ticker. We do this every macro Monday to start out. I'm clicking on 1 month. I want to look at supply and contract activity. I am outlining them with the box. Let's just go over this really quick, guys. Over the last 30 days, we've had 1,796 new listings that came on the market in the last 30 days. That does include the end of May. Right here. That's the end of May right there. So we have to another week and a half, 10 days or so of April. We're supposed to end the month at 1710. So right now we're a little bit above where we typically come in. But it seems a pace, Johnny. It seems a pace.
Look, last week was a holiday week. So you're obviously going to have a decrease in listings and contract activity at the same time. The question is, how are we going to bounce back? So I think we're going to definitely bounce back on the supply side, maybe not to the same peaks that we saw. The contract side, I'm a little, hesitant on saying, I'm a little hesitant on endorsing a return to spring form, but, we'll have to wait and see.
Yeah, we're in the third or fourth inning, right? Every week that comes by, we're getting closer and closer to seeing how this is impacting us. Well, let's just take a look at the numbers first, John. Over the last 30 days, we've had 1,030 contracts signed. We are supposed to end the month of April at 1,089. 1,089 is our baseline. And what worries me is take a look at the end of March, right? As we get towards the end of April, this is going to fade out of this number right over here. And that's a bunch of contracts signed right over there. I mean, you got 52, you got 53, you got 54. That's a lot. So what's going to come in, right? I don't know if we're going to sustain that place. Basically what I'm saying is I don't know if we're going to beat the 1,089 number with what's going on macro-wise.
Well, I'll tell you this. So 1,089 number, that's your liquidity number. But if you go to monthly contract signs, it's roughly the same on the month. So we have 9 days left in the month. And I think we're about 50 something contracts away. I think we can do it, which would be interesting because if we did get across that sort of seasonal threshold for April, that would be the first time this year, actually, Noah. So despite the fact that March was great, it didn't necessarily eclipse that seasonal number that was expected. So we've been down, January, February, March, we're all slightly below seasonal averages. This would be the first one above, which honestly, I would not have expected, given the tumultuous weeks that we've had to start off April. I would not have expected that, but here we are. Let's see how this happens.
I'll just say 1 week, 244 contracts signed. That is not bad. For a holiday shortened week, that is not bad at all. Again, let's see how it goes. It's an interesting 10 days. You could see that we're ticking down a little bit over here. I was kind of hoping this would be our first spring season uninterrupted since 2022, but I don't know. It may not be the case. Johnny, let's move on. I want to go to credit spreads. Okay. Credit spreads is our guide as to the craziness that's going on out there in the macro world, guys. As credit stress rises, which is indicative of this chart. I only got 6 months up here, but if I click max on this chart, you will see that's the great financial crisis over there, went all the way up to 1. 1 represents this right side ticker of this credit stress index, which is high, by the way. Okay. That's the great financial crisis. That's the pandemic. So now, when this goes up, bad things are happening. We call it risk off. Stocks are selling off. Buyers are probably pausing. We might go in a down cycle, et cetera, et cetera. Now, if I go to the last 6 months, that is what we've just experienced. Now, what I want to bring up is for the last week or so, it's been kind of coming down for the last week or so. But take a look at the very last print right over there. So I'm going to draw what I think is going on. So we went up, right? We went up. That's this period right over here. Went up. Then we came down. It was looking good. But now we did one of these kind of things. And when you stop going down, is that the precursor for this to go back up again? And when I'm looking at the stock market right now, I have a feeling credit spreads are widening as we speak today, Johnny.
Yeah, no, I think it's a good point. I mean, one of the things that we saw is how fast that credit spreads can ratchet up. So we had been on this long process from, I mean, really since rates started hiking in 22 and credit spreads sort of followed along with them. We've been in this long sort of deceleration where the spreads have slowly declined. They never got back to where they were at the post-pandemic low because the interest rates were higher. But we've seen that spike back up, and it really is something that we haven't seen in terms of the magnitude and the sort of the vector has just been up, and we haven't seen that for a long time. And it was straight up, and you're right, it's coming down, very fast to come up, slow to come down. And the fact that it's pausing here, I tend to agree with you that it's sort of in wait and see mode. And I hate to say that we're also waiting to see on the market, but there's a lot of waiting and seeing going on. So the market's constantly trying to price this, constantly trying to get an understanding of what could be coming down the pike. But I feel like there's just the news flow coming in is not necessarily one that sort of says, okay, maybe that's all in the rearview mirror. Let's think about the future now. No, it's what's happening underneath our feet seems to be the news cycle at the moment.
Yeah. And I'll just point out that we remain in this moderate credit stress state. All right. You want to watch this ticker. Do we go this way, which is bad? You can see high credit stress. You do not want high credit stress. This way is better. As long as you're in this moderate credit stress state, you could wake up to days like this. And that's the whole thing that's going on over here. I really want to know which way this goes. I don't care where we did already. Does this go up from here like that? Do we stay at this level? Or do we go back down? That's like what I'm trying to figure out that's going on. And right now, it looks like we're going to be starting to heading back up again based on what's going on with the market today. So we'll keep an eye on this. This updates every day at 10:30. You guys can come to creditspreadalert.com and update this.
Yeah, I think the one takeaway is, I mean, despite the fact that this has been fast up, if you zoom out, we're nowhere near the levels that we saw in 2008, nowhere near the levels we saw even with the pandemic. So the ultimate fear with credit spreads, when they really blow out, the ultimate fear is that liquidity spigot just gets completely turned off. So forget about mortgages, forget about any kind of, activity, any sort of, borrowing activity, lending activity basically comes to a halt. So we're not really in danger of that just yet. However, we are at this new level where the cost of money could become significantly more expensive, but there still is liquidity. So let's have to see how that plays out.
Yeah. And I'm glad that you brought up the whole history of what's going on here, because we are still at a low level. It's a little scary, right? I mean, we've been through this now. We're starting to see this rise a little bit. It gets a little scary out there. You can imagine if this just keeps going, what that will look like. So that's why we watch this as a guide. Okay. We'll keep an eye on that and keep you posted.
But before you jump to this, I just want to do a quick housekeeping. So we're trying to track the comments. They're a little bit slow. There was a comment that someone wrote in that the charts are a little small on the shared screen. So I just want to say, if you're not following the comments, we'll try to work on making these charts bigger. But this is our first week using this new software called StreamYard. So we're broadcasting live. It's different from Zoom. But please, if you have any feedback or anything for us, always happy to hear. We'll try to make this experience good for everybody. So let us know.
Yeah, and I have no idea what this looks like. I'm just looking at my screen. So you guys need to tell us what we need to change, and we will change it. Okay. Let's go to the Fed, Johnny. Let's go to the Fed. What is the Fed going to do with rates? Well, we don't know what the Fed's going to do with rates, but we know what the market expects the Fed to do with rates. And that's what this site is, guys. I'm at the CME group. I'm at the Fed Watch tool. Okay. Hopefully you guys can see this. Oh, the screen right here. This is the Fed Fund Futures. Okay, guys. We are here at this level, 425 to 450. This on the left. Okay, right over here. These are the future meeting dates. Look at the dates, 25, 26. These are in the future of the dates that the Fed is going to meet and make a decision on interest rate policy, whether it's a hike, a pause, or a cut. If we're here, anything to the left is a cut. Anything to the right is a hike. So we're really only talking about cuts right now. And as I see it, and I'd like to think I'm reading this table correctly, the next meeting is May 7th. There is a 90% chance of no move at all. So that's a pause. Call it a P. Okay, guys. June 18th, we still have our first cut. That hasn't really changed very much. 67.5% quarter point cut down to this level. July, that's now a cut. 62% that we're going to cut one more quarter point. So that's 2 cuts. September, another cut down to here. So right off the bat, the market pause, then cut. That takes us to September. And finally, to finish the year, we got December right over here, one more cut. So the markets are pricing in 4 cuts this year. Okay, 1, 2, 3, and 4. But look at the percentages. Okay, 67.5%, that's pretty high. We're probably going to get that cut. Still 25% chance of a pause. 62, that's pretty high too, even though you got 29 here, but that's a high number. And then it goes down to 50s. Once you get down to 50s and below 50s, you got to be very careful, guys. But 4 cuts, that's what's planned. That's what's expected. That's what you need to know.
Right. So there's a couple things I'd bring up. The first is that the 67% cut in June, that's 67%. That's sort of the higher number that we've seen. I think earlier this morning it was down to like 61, 62%. So that's up from that. Last week it was in the low 50s. So it's been kind of slowly moving toward this expectation of a cut. At the same time that the Fed has suddenly moved into the headlines too, with this perhaps this idea that Jerome Powell, who's the president of the Fed and also sits on the Federal Open Market Committee, could sort of maybe be terminated somehow. So there's a question now about the Fed independence. And I think, you think about credit spreads, you think about what makes them tick. Like Fed independence is is a bedrock in terms of this chart, because as Noah's talking, right, you're thinking about, all right, let's look at these blue boxes as a guide to the future. If the Fed was not independent, right, this is just hypothetical. If the Fed was not independent, this could sort of vary just depending on the whims of an administration. So that the tampering with that Fed independence, I think, could help widen credit spreads even more, because it's throwing a bit more uncertainty in there. But just a quick housekeeping note on the Fed, right? The Fed has it has a board of governors, and then the rates are actually set by a different part called the Federal Open Market Committee, the FOMC. So even if Powell is taken out of the Fed presidency, he could still be appointed to the FOMC board. That'd be very awkward, but it could happen. So there's a lot happening behind the scenes, and I think that's sort of rattling some cages. So interesting to see how this plays out too. Another wait and see moment for us.
Yeah, it's just adding to uncertainty. It doesn't help. It doesn't help when you add to uncertainty, and that's on the Fed, executive side. We're going to see how that all plays out. I don't know. That's some crazy stuff right there. It's definitely above my pay grade on what's going on over there. But the Fed has been tried to be at least independent, and the fact that they're now talking about this kind of stuff is a little troubling. I wish they would just focus on policy matters, not this kind of stuff. But here we are. So we got to keep an eye on this. I don't doubt that credit spreads widening a little bit that's part of the equation too. It could be. Yeah, it could be. So there's a lot of uncertainty going on right now. I think that's what the stock market is doing. It's repricing all this risk. It's repricing everything. And this is what I see right now, guys. This is what you need to know. There's 4 cuts. That's what the market expects. 4 cuts this year. 2 of them look like pretty concrete. The third one, 50-50, and then the fourth one's 39%. So I don't know about that. So we'll keep an eye on this. Mortgage rates, though, I mean, this is what's so crazy. Usually when you have a risk-off cycle and you got credit spreads widening, typically mortgage rates would go down. And that's what's so crazy. The historical correlations are like out the window right now. Like stocks down, US dollar index down. That's a strange correlation. Stocks down, mortgage rates up. That's a strange correlation. There's some weird stuff going on right now, which tells us that there's some credit plumbing problems potentially going on. That's why credit spreads are widening. But look at this. Like, I don't remember. Look at jumbos, John. Like a week and a half ago. Look at how high they peaked, and they've come down. It looks like a one-day print or something. It must have been this like a glitch in the matrix or something like that. But it's come down a little bit. But mortgage rates are still at a higher level than they were a few weeks ago.
Right. And I think, that long-term trend in mortgage rates has been, you go back to the beginning of this chart, this is about a year ago, it's a 1-year chart. So we're definitely lower than we were last year, which I suppose is a good thing. But we're nowhere near the low that we saw in September, October. We've bounced back off that, and the trend is a rising trend. And I think, you talk about what was happening in the markets, that those correlations, those long time ones, have been sort of thrown out, right? You have stocks going down, and you have bonds going down too. So you have it's a mix of what normally happens. Usually people sell their stocks and they buy bonds because they want the safety. But we're actually seeing a bit of deleveraging versus the U.S. So that people want to take their money out of the U.S. and put it in someplace else, whether that's the euro or Japanese yen or something like that. So we've seen the dollar index fall. That's the DXY. So you can track that on whatever chart platform you want to use. It's actually below 100, but just it's been a sharp fall in the value of the dollar. So there's actually a question in the chat which talks about, how does that affect real estate? Well, it makes New York, this is our market, right? Manhattan, Brooklyn, et cetera. It makes that a lot more attractive than it was several years ago. But or not several years ago, I should say, but even last year, right? That dollar index coming down makes New York real estate cheaper. But you have all the political uncertainty that you have to deal with, and the economic uncertainty too. So it could provide a bit of a tailwind for some international investors, but let's see if they take advantage of it.
I mean, the way I look at mortgage rates in New York City real estate is we have 65% cash deals in our market. So it's like, number one, it's a muted effect. Number two, it's affecting really those 2-3 million and below sectors that are relying on financing. So you might see some slowdown start to happen in those sectors a little bit. And as John said, number three is that, maybe you have a foreign investor play on the dollar, but that's stretching just a little bit, I think, because as John mentioned, you got the uncertainty element, stocks going down. That kind of counterbalances any benefit from outside investors. Usually when uncertainty rises, people pause. When mortgage rates rise, either they're going to rush in to kind of lock it in, or they're going to pause and wait for it to come down. You know what I'm saying? But our market, nonetheless, again, big cash market. We'll get back to that. We got a lot of housing charts to show you. Last macro point, guys. This is inflation expectations in the New York Fed services index that they have. That's really what's going on. Everyone's expecting inflation with tariff uncertainty. Everyone's expecting higher prices, and decisions are being made. We haven't had the higher prices funnel through to the economic data. That's going to be like 1 or 2 quarters from now. That's yet to happen. The people's the perceptions, the executives of these, the orders that they're placing, that's all being changed right now by expected inflations. And that's what this is showing. So that's what's adding to this uncertainty element that's going on here. Just wanted to point that out. Okay.
Yeah, and that's just to bring it back to real estate. So you're absolutely right, Noah, that the mortgage rates does not have that same sort of strong correlation that a lot of people expect. Oh, mortgage rates are down. That means contract signs are going to start flying. It's the same with that expectation. And I think one of the expectations that might be more salient now is rental expectations. We've seen Manhattan rents sort of break through their highs, and it's not even summer yet. Brooklyn's pushing, hasn't gotten through it yet, but all indicators look like this could be a tight rental season. Now, obviously, who knows what's going to happen, but judging by the data that we've seen in March and early April, it looks like it could be tight. So if you're planning on making that purchase because you've already got a rental renewal and it's much higher, or you're looking at expanding and going to a larger place, and it's like, do I want to spend $15,000 a month on a 2-bed, or do I want to buy one and have my monthly expenses are $8,000, right? So you have some math to do, which the purchase math actually looks pretty good for a lot of people for the first time. So it's going to be, again, one of these things that's going to be interesting to see how that plays out, because a lot of these decisions, once they're made, they take time to work through that process. So given the fact that it was a holiday week last week, plus that uncertainty, I'm wondering if how many of these people who've made that decision sort of return to the market in earnest.
That's an interesting point. I guess we'll have to look at the data as it comes in. I want to shift now to housing national, guys. I want to, there's a point to all this. I want to ultimately relate our market to what's going on outside of our market in the housing market. Okay. I got a couple of charts to show you. This is from Resi Club. I love this guy, Lance Lambert.
Resi Club.
This is the change in metro level home prices since each metro's respective peak in 2022. Okay. So what they're basically saying is that housing prices reached a peak in 2022 and have come down since the Fed started hiking their rates, right? Most housing markets have had some level of correction. Now, look at the left color scale over here. Red, orange, that's down 15% from 2022. Okay. And then the blue is going to be up since 2022. Look at some of the areas south first, guys. Look at some of the numbers here. Down 23% for Austin, down 17% Punta Gorda, down 12% Cape Coral, down 10% Phoenix. And then look at the Northeast region, how it's mostly blue, right? I just want to show it to you guys because the national housing market in a lot of sectors is well into a housing turndown. Whereas in Manhattan, for a short period of time, we were having the best spring since 2022, which is ironic enough that we were actually getting out of our volume trap. The shape and the form of whatever cycle Manhattan real estate has with everything going on is going to be very, very different. The duration of it, the look of it, the style of it, the depth of it, all that type of stuff is going to be very different this cycle than other markets outside. And that's what I wanted to point out here, John.
Well, it's really interesting. So do we have another chart on the supply difference, the supply change for these markets over that same period of time?
I don't think I have supply this week.
Right, because I think that if you look at some of these other markets like Phoenix or Punta Gorda, Austin, supply has really increased. And a lot of 2022, that growth in price was predicated on very, very tight and almost non-existent supply. Right? I mean, I think back to the pandemic spike that we had, post-pandemic spike, that recovery that started late 2020 for Manhattan. Brooklyn started right off the bat, but it was impossible to find anything. When you did, there's all that competition that really pushed prices higher. It was magnified in some of these other areas. And I think that prices coming down could be a reflection of supply coming onto the market, could be a reflection of the higher interest rates that we've seen. It could be a reflection of the fact that maybe people are moving out. But I'm wondering if people are looking at Phoenix down. Someone commented that the charts are a little fuzzy. They are a little fuzzy. So we'll have to figure that out. I can't quite read the fine print. I mean, it could just because, my eyes are going, but whatever. Anyway,
we're gonna have to upload these images into the thing and probably overlay them then rather than
we'll make it sharper. But the fact that Phoenix is seeing a downtick in price, I wonder if that's the signal for people to buy Phoenix. Like, hey, maybe it's time to come back in. Maybe it's time to come back into Punta Gorda. Maybe it's time to come back into Austin, to buy. So interesting to see how this will play out.
Yeah, we'll see. That's a very contrarian take there, Johnny. Meanwhile, I'm going to try to show you guys the UrbanDigs Market Index. Hopefully you guys can see this. It's not that fuzzy. You know what? I may put this on the site, these slides, so that you guys can at least see these things in clarity on UrbanDigs while we learn this whole new system. Okay, guys, bear with us. But here's the UrbanDigs Market Index. This is basically a model that John and I created for the Manhattan market. It's like the Case-Shiller. It's like the Case-Shiller for Manhattan that shows our price action. And I mean, look at the last 10, 12 years, guys. Like, again, we've done a whole bunch of nothing. So I feel like our market is suppressed. I feel like we've been kind of just stabilized. We have not had any crazy housing growth. A lot of those other markets, if I just go back here, if I look at some of these other markets, Punta Gorda, Cape Coral, Phoenix, these guys are probably up 100% over the last 10 years or something along those lines. Now they're starting to come down. Whereas you look at Manhattan, we're just not. So it's a different market, different structure. We're a co-op based market. We're not a speculative based market. We're a very high cash market. There's a lot of different things going on in our market for good and bad, right? I mean, we got the commercial sector problem. We got the policies of the multifamily market. That's kind of restrictive, so we got good and bad things going on. But I think this is a protective element for our market while all this is going on. Will we be a safe haven or at least viewed upon?
I mean, it's a great point because the green line, which is where we currently are, if you just draw that to the left, you can see that we're just sort of bouncing along. And that's what we've seen is this, that prices go up, but they're not really progressing to this new level. And you think about the times when prices were down and then rallied back, right? So you have right after the Great Recession, 2008, 2009, and then from 2010 into 14, there was a rally up. Same thing after the pandemic, right? The prices were a little bit slow, but that was not necessarily pandemic related. It was just sort of a hangover from the previous peak, but then the prices rallied. But there were so many, I don't know, for lack of a better phrase, so many animal spirits that were just animating the market. People were just out and about. The buyers were out and about. Sellers were not interested in negotiating at all because the supply was tight and the buyers were out. And that's really what pushed prices higher. So I kind of like the fact that we're in balance. Like we're seeing supply running at around seasonal levels. We're seeing the buyers come in right around seasonal levels. So I like this balance. I like this sort of churning in the market, which I think is good for the agent community because it lets agents sort of remain in the center of the deal, and it doesn't necessarily shift full leverage to one side or the other. So I think I like a market like this. I like a market in balance, and I feel like that's where we are now. So I'm very wary about one side having too much leverage.
I'll give you props for being consistent. You've always said that. You've always said that you've liked balanced, neutral kind of markets rather than a buyer's or a seller's market heavy in either way, because there's an imbalance there. You like efficient markets, stable markets, balanced markets. Props to you, John.
Well, thanks. Here's what we're seeing right now in the stock market is we're seeing that imbalance, and we're seeing that price discovery process, which frankly is messy, right? When stocks are all over the place and real estate's all over the place, it's a very messy process, and it's fraught with uncertainty, and it's really hard to act under uncertainty. So listen, I mean, obviously we are huge fans of agents, and we think the role of agents should be essential to any real estate transaction because it's so big and so central to people's lives. So why throw an added wrench of uncertainty and just make people think either they're leaving money on the table or it's not a good time to do something? Like it's a very fragile time. So I want to protect that. I want to wrap it like the egg drop, wrap it in the bubble wrap so it doesn't break.
I love it. I just want to point out with this chart, guys, this is January's print. On April 1st, January's print comes in because it's a 2-month lag. February and March was a 2. On May 1st, we're going to get February. So this is going to rise. And this is another thing for sales data, guys. The Q2 report that's going to ultimately come out in like 3 months from now, that's going to reflect a lot of activity, maybe pre-tariff. I feel like you have some strength in the sales data. Deals that are happening today over the last week and a half with this whole thing going on, you're not going to get that data in the sales report for 3-4 months. It's more like a Q3 thing. So I want you guys to have in your head that the next round, the next wave of sales data that's going to funnel in over the next couple of months is really deals signed like, late January, February, and March. You got to think of it that way. Deals signed in early April, those aren't going to close until, June, July. Kind of thing. And then we got to wait for Acris to file those filings another couple of weeks after that. So it could be getting into end of Q2, early Q3. Just don't forget the lag when you're talking to clients. There is a difference between the real-time markets and this lagging sales data, especially now.
And again, thank you, Noah, for bringing that up because you're absolutely right. And one of the things that I think, again, the agent community brings to the table is the ability to sort of, once something's closed, it's not recorded, you can reach out, you can bridge that gap. So again, it's a very crucial moment for that. So
excellent time for intelligence. Tap all of your friends that you've made, your colleagues that you have trust with, especially if they have deals signed and you have buyers trying to figure out where today's market is. Whatever intelligence you can get to pass on to your clients is going to be very, very much appreciated in times like these, right? Because buyers and sellers want clarity. All right, let's just move on here. We're running out of time. This is a forecast now. Let's go look in the future. So this is not in the past. This is Zillow. All right, Zillow. The estimate was like, a little BS kind of thing. Whatever, marketing gimmick was that guy. But Zillow, they're still pretty big, and they got a lot of data. Their forecast from March 25 to March 26, so their 1-year forecast, every single metro market, okay? Hartford's not metro. Every single metro market, they are forecasting to be negative. So Zillow has a bearish look on the overall housing market based on everything that they're seeing. Take a look at this right table, Zillow forecast 1 year, the right table over here, the blue. These are the 30 metro markets I was talking about. Every one of them is negative.
Can you zoom? Is it possible to zoom in just a little bit for those of us with the smaller screens? I mean, it's better.
I know. I will put this on the site, guys. I will put this on the site. Yeah, we'll figure it out. Oh, see, I zoomed out. New York is up here. Now, there's two numbers here. The right is the Zillow forecast, down 2.4%. That's what it says, which is probably on the lower side of all these numbers, maybe mid to lower. Reventure is a different data analytical company. You guys can look them up. They're more on the commercial side. They have a 4.8% positive run for New York over the next year. I got to be honest with you. I'm kind of in ReVenture's forecast, not Zillow's. I think that we're going to pump out a positive year, even with all this stuff that's going on, because of the nature and the structure of our market and where we just came out of. We just came out of a 2-year slump, and I have a feeling, could be wrong. I have a feeling this is not going to be very deep. I hope, at least. I know we're in it now. It doesn't feel that way, but I hope it's short-lived. But it's interesting. Zillow down 2.4% in a year, ReVenture up 4.8%. Who's right?
Are you asking me? I don't know who's right. I would probably say that we're on the upside, but again, I mean, we've got a piece coming out in Forbes. We talked about this on the Friday update. Your mileage is going to vary depending on what neighborhood you're in, what kind of prop type you're in, what sort of bed count you're looking at, what your price range is. So all of these teeny tiny, not even like micro markets or slivers of micro markets will add up. And I think when you take it all together, that median is going to be positive. So I do have some hope for the New York market still. I've been pleasantly surprised to see the contract volume come in despite all of this activity. I am worried that it's front loaded. I'm curious to see what's coming out the next couple of weeks. But that being said, I think that there's the bid is back for Manhattan real estate, and it's not overwhelming. It's sort of in balance, and I think the rental market's going to pushing it. I think the lower mortgage rates have been pushing it. So I am curiously or cautiously, I suppose, optimistic. But I think it really depends on what sort of market you're in. So if you're in like a studio co-op, it might be totally different than if you're in, you know, a 3-bed downtown condo. Like these are gonna see totally different markets. Which one is going to win? I don't know, but I think overall will be positive.
Yeah, it'll be disparate. The luxury sector and the lower end definitely. But yeah, we'll track it, and we're trying to find new ways to report on the different aspects of all the different micro sectors that we're following. So the next couple of years in UrbanDigs, we're very excited about the stuff that we're going to be pumping out and building with these different divisions that we got working on internally. So we'll try to bring clarity to all this stuff to make your job easier. Don't worry, we'll do our job. Finally, guys, this is the last slide. I'm going to put you guys through the last fuzzy slide. Hopefully, it's not
finally.
Loan to value. The average loan to value for all outstanding mortgages is 46.9%. 46.9. Only 0.3% of borrowers are underwater. This is a national stat. Okay. Total borrowers in delinquency is creeping higher. It is definitely going higher, but it's very, very low. Let me tell you what to look at, guys. Look at these colors, negative equity colors, 91%. These are the trouble spots. These guys right here are the high. They got high debt. Okay. All the other guys have a lot of more equity. So this is what I was saying, the structure. I don't think the housing sector is going to be the catalyst in this cycle. There's been a lot of speculative mania, guys, I'm going to look at the camera for this. There's been a lot of speculative mania over the last 5 years. Remember people paying millions of dollars for NFTs? Bitcoin's still doing its thing. A lot of other coins kind of got hit. But there's been a lot of speculative mania in the chip stocks and in other stocks that have done crazy, crazy things. If there's going to be a bubble popping, I don't know if housing is going to be the sector. And I certainly don't think it's going to be Manhattan real estate. That's kind of the thesis, I think, of what I think is going to be something else, whether it's crypto or something else. I don't know, but I don't think housing structurally is the bubble asset class.
Yeah, well, first of all, I love this chart because it does speak to that balance that I do like so much. So the idea that underwater, the people who are negative equity, you can't even see it. It's so small, you can't even see it. That's a really nice thing to see. So I'm hopeful that a lot of the reforms that were passed after the Great Recession have really taken hold, and this is not just some sort of mirage because mortgage rates were so low that it's impossible to have negative equity. And the housing prices have risen. However, that being said, like I'll take this at face value and I'll say that this market does look strong. It does look like people are able to stay in their houses and weather any sort of storm. Like if you're in Phoenix or in your Punta Gorda, some of these markets where prices are down, you're still hanging on to something that you're not underwater in, which is good. This is a good thing for consumers. And if they need to, they could tap the equity in that to pay other debts that they might have. So I don't necessarily want to think about people getting into a debt spiral, but the fact that equity remains and equity is somewhat strong with the American consumer in terms of their house, like that's a good sign. That's a good sign, and I hope we can hang on to it.
Yeah, and guys, thank you, John, for saying that. I want you to understand what we're trying to do here. You guys are having conversations with very, very smart people, Wall Street people, foreign investors. The topic may come up about how does Manhattan perform versus other markets, I heard the American housing market's in a downturn. You now have talking points to discuss these types of things intelligently, and that's the purpose of us doing this type of stuff. Is if I can have you guys leave this show with a couple of actionable takeaways and a little more clarity on what's happening in our market, even though we're talking macro stuff, then we've succeeded with the mission of Macro Monday. Okay, guys, that's the whole purpose of it. Our mantra, the real AI is agent intelligence. That's what's going to get everyone through and give you a competitive edge. That's what people want.
Speaking of which, and this is just a total aside and a plug for UrbanDigs, but we like AI as agent intelligence. We actually whipped up some fun ads. So hopefully with this new setup, maybe we can actually stream them somehow. They're funny. You'd enjoy them, but maybe we'll get to that. But I just want to echo that. I just want to echo that point. No, you're absolutely right. So it all comes down to putting these things into context and turning it into a conversation. And I hope it's helpful. And if not, please let us know. Any feedback you guys can share with us will be greatly appreciated. And
fix your damn charts.
Well, that's on you.
Non-fuzzy charts.
Throw my hands up on that one. I'm too busy trying to sell my $1 million NFTs to worry about your charts.
Yeah. We'll work on that, guys. I'm going to see if I can get this PDF up here somehow on these charts, on UrbanDigs. Give me a day or so. And we will try to fix this for next time. But other than that, I'm excited to move to YouTube. Hopefully you guys at least found this platform, easy to use, and we'll work on those charts. But thank you, John. Welcome for everything you do. I am Noah Rosenblatt. We are both with UrbanDigs. This has been Macro Monday, and we'll catch you guys next time. Cheers, everybody.
And a quick PS, we're going to stop the stream and then it'll do its thing. And it should be available right on YouTube. So I think we saw some comments in there about people, is this going to be recorded? It should just show up on YouTube. So hopefully that'll be it. We'll figure it. We'll find out. And thank you. And we'll see you next week.